Indexing, or passive investing, started out and is more predominant in equity funds. Equities trade on an exchange, they're very liquid, and therefore they're relatively easy to index. On the other hand, bonds are traded over the counter. They're not as liquid. They trade less frequently and have higher trading costs, and there are also many more bonds out there than stocks. For these reasons, indexing fixed income is more difficult. However, fixed income indexing has been growing rapidly in the past few years. Looking back to 2008, passive fixed income funds held 13% of assets. From 2008 to 2013, the category enjoyed steady positive flows as investors remained in flight to safety mode even after the financial crisis ended. Most of these flows went into active funds until the so-called taper tantrum of 2013 caused a sudden reversal. After the Fed's mention of potentially tapering the QE program, investors began to plan for lower returns and became particularly sensitive to cost. Before, when an active manager had the potential to bring in higher returns, investors were also willing to pay a larger fee. Now, however, if they know they have to settle for lower bond returns, investors are beginning to look for less expensive options. So, in this context, the passive share of fixed income assets doubled from 13% in 2008 to 26% in 2015. In conclusion, fixed income flows are very sensitive to interest rate movements, and investors are now positioning themselves for a low-return world while trying to control costs. This will continue to be an interesting story going forward because there's still uncertainty about when and by how much rates will increase, and that is likely to keep flows volatile for most fixed income categories.